Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Key Steps for a Successful Business Transition. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce our Moss Adams presenters for today's session, Mark Steranka, Partner, Dustin Snyder, Senior Manager, and Aaron Martinez, Director. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Aaron to get the presentation started.
Thank you, Amy. If you're watching this, it's likely you're considering a business transition, and you probably have questions like, what's involved with transitioning my business? What's my business worth? How do I take care of my family? And if you look outside, your questions might be, what's the time frame for selling my business? How fast or how long will it take? Should I try to sell the business myself? And how do I preserve my legacy? Selling a business can be difficult and stressful. And over the next 45 minutes, we will attempt to answer these questions and many others that you haven't even thought of yet. First, we'll take a look at the realities of the market. What are the micro or macro trends? We'll take a closer look at how the macro trends are affecting your industry, giving you an understanding of what's driving the M&A market now. And lastly, look at valuations. What's my business worth? Since taxes will have a significant impact on your decision, we'll get a view of current and proposed changes to tax law. And finally, we'll discuss 2 scenarios: internal transition, keeping the business in the family, and external transition, selling to another party, whether it's a strategic or financial buyer. We've got a great audience today, so please post your questions as we move along, and we'll answer as many as we can at the end. And thank you again for joining. We look forward to the conversation. Amy, I think we have a polling question, so I'll pass it to you.
All right, thank you, Aaron. So our first polling question is to get a feel for our audience today. It is, what industry are you from? A, construction, B, architecture, C, engineering, D, construction materials, or E, other. And we will give you a few moments to respond. Please click the button next to the answer you choose and hit submit. And if you cannot see the submit button, just enlarge the slide area so that you can see it. We'll leave this up for another 5 seconds. Okay, here are the results.
Thanks, Amy. That's interesting. There's a lot of folks here, and I know there was some new news today coming out on where the administration is on some current policy. So why don't we go ahead and advance, and then maybe Dustin, can you pick it up from here?
Sounds good. Thanks, Aaron. So the construction industry's revenue generally correlates with fluctuations in macroeconomic conditions. Some of the positive macro trends we are seeing are low interest rates, an increase in residential construction activity, and unfortunately, natural disasters. Low interest rates have created a favorable borrowing environment for both residential consumers and non-residential clients. On the negative side, we are seeing labor shortages, wage pressure, and poor non-resident market conditions. Whenever we perform a valuation for a client, we have the privilege of interviewing owners and key management. Virtually every business owner I have spoken to this year has said that one of their most pressing issues is finding people. This issue is impacting a broad spectrum of industries presently. The graph to the right displays the construction and engineering industry average market capitalization on the left vertical axis, as well as the market capitalization for the entire S&P 500 index on the right vertical axis. For those of you who don't know, market capitalization is simply the market value of equity. The market capitalization for the S&P 500 tops out at $37.2 trillion as of July 31st, 2021, while the average industry market capitalization was $2.3 trillion as of the same date for the construction sector. Overall, the graph shows that we have seen a strong recovery in market capitalization since the COVID-19 induced Q1 2020 lows. This is a positive one for valuations of privately held companies. IBISWorld, which is an industry research firm, in its May 2021 report on the U.S. construction industry, stated that revenue declined 0.4% in 2020 as a result of the COVID-19 pandemic, but is expected to rebound as construction activity across the economy picks up. Some construction projects that were expected to come online in 2020 were delayed to 2021, which is why we see the significant increase in revenue growth to 5.2% this year. Over the 5 years to 2026, industry revenue growth is expected by IBISWorld to increase at an annualized rate of 1.9%, which is below the average historical growth rate of 4% observed from 2013 to 2020, which is represented by the green line or the light green line on the chart. Future growth is expected to be driven by the overall economic recovery from the COVID-19 pandemic and the relatively low interest rate environment. As a side note, all of the growth figures presented and quoted are in terms meaning they exclude inflation. Let's take a look at M&A activity in the construction and engineering industry. The graph on this slide presents construction and engineering M&A transaction activity in North America from Q3 2016 through Q2 2021, provided by S&P Global. M&A activity in terms of number of transactions, as represented by the green line, reached a period low of 54 transactions in Q2 of 2020. However, volume has steadily increased since then, reaching a period high of 143 transactions in Q2 2021. So in terms of transaction count, There has been more M&A activity over the 12 months ended Q2 2021 than any other rolling 12-month period in the last 5 years. Deal activity in the construction and engineering industry has returned to pre-COVID levels and is expected to continue to be strong due to potential large-scale infrastructure spending on the horizon and favorable interest rates. And as a side note, we just found out about an hour ago that the $1 trillion infrastructure bill passed through the Senate. There is also an abundance of capital out there right now. According to PwC's Global M&A Industry Trends 2021 Mid-Year Update, there is more than $1.9 trillion of committed but unallocated capital, or dry powder, as they say in the industry, held by private equity. Capital inflows led by SPACs have been a key catalyst, as has been the increase in PE investment and corporate acquisitions, especially in the technology sector. Interest rates have been low and are expected to be low for the remainder of the year, providing ready access to cheap capital. The aggregate transaction value in this graph, represented by the bars, is not particularly meaningful, as most of the transactions did not report the transaction value. For example, in Q3 2019, there were 116 transactions, but only 12, or 10.3%, reported the transaction value. So M&A activity is strong right now, and there are definitely willing buyers and sellers out in the marketplace. And now that we know M&A activity is not only present but strong, let's look at how valuations have behaved recently. The graph on the left shows the enterprise value to EBITDA multiple for public companies. This valuation multiple is derived simply by dividing the market-reported enterprise value for a publicly traded company by its EBITDA, or earnings before interest, taxes, depreciation, and amortization. Enterprise value is defined as the market value of debt plus equity less cash. The enterprise value to EBITDA multiple is a widely used metric for determining the value of privately held companies, assuming you can find publicly traded companies that are reasonably comparable to the private one. The graph shows that the EBITDA multiple for the S&P 500 index has generally been on the rise since the end of 2018, and reached 16.7 times EBITDA as of July 31, 2021. As shown by the gray line, the industry median for publicly traded construction and engineering firms is much lower at 9 times EBITDA as of July 31, 2021. The gray line shows that the median valuation multiple for the industry has returned to pre-COVID levels, which is good news if you are planning to sell your business in the near term. The noisier graph on the right shows the EBITDA multiple for M&A transactions in the construction and engineering space. This data includes fewer data points than the publicly traded data on the left and is therefore a bit more volatile. It does show, however, that the median EBITDA multiple for the M&A transactions has ranged from 2 times to 12 times EBITDA, with a median of 4.9 times EBITDA over the entire period. Now, as a private business owner in the construction and engineering space, my overall take on this data would be a favorable one that shows support for the kind of valuations we experienced before COVID-19 pandemic. Besides valuations, potential tax changes are a factor that could impact not only your company's value, but what transition strategy you choose to use and the timing. This table shows 7 key tax changes that have been proposed by the Biden administration or Senate bills. While there is significant uncertainty surrounding these proposals, it's still important to pay attention to what could happen and how it could impact a potential transition. We'd like to highlight number 2 if you are preparing or contemplating an external transition. At present, the current long-term capital gains tax rate is 20%, and there are proposals to increase long-term capital gains tax to 39.6%, which is obviously significant. Number 3 becomes very important if you are considering an internal transition and potentially need to gift ownership in your company to the next generation. Presently, any gifts below $11.7 million would not be subject to gift taxation. If the proposed law gets passed, we could see the lifetime exemption decreasing significantly from $11.7 million to anywhere from $1 million to $3.5 million. This would have a significant impact on your gift tax burden if the size of your gift should exceed the proposed levels. Now, while these changes are uncertain, they should be considered when thinking about when and how to transition your business. Our valuation practice has seen a significant increase in the volume of valuations prepared for gift tax reporting in the third quarter of 2020 and year-to-date 2021, which shows that a lot of our clients are moving wealth now to take advantage of the presently more favorable tax laws, especially the higher gift exemption level. Now I will turn it over to Aaron, who will discuss key considerations that need to be made when considering a transition or exit.
And actually, this is Mark, and I'm going to take this one. Thank you, Dustin. And boy, I was listening to what Dustin had to cover, and I thought, oh, we said we're going to cover internal and external exit strategies, and looking at the market data, it was be like, why would anyone consider an internal strategy when the market is so ripe for M&A activity? But really, there's a lot of considerations that go into what is the right path for you. So as either a business owner or an executive that would be impacted by a transition, here are some of the things that you might want to think about in terms of what is the best path. So I'll just go through each of these briefly. So management team. Do we have a solid management team in place today? Or might there be a gap from ownership down to in sort of middle management, and we've got work to do? And if we're in solid place in terms of our management team, that makes us more conducive for an external transition. If we've got some work to do or some gaps to fill in our management team, experience to develop, then an internal transition might be better because that gives you sort of the opportunity, the time, the flexibility to work on that. So that's one consideration. Ability to fund a buyout. So let's say you're thinking about internal. Do the potential buyers, other employees, have the wherewithal to fund the buyout? You might have that capability within your organization in terms of both particular individuals or number of individuals necessary to do that, or you may not, and therefore may need to think externally just from the mere fact that there's not a feasible way to even accomplish it internally. A key factor in that ability to fund the buyout is what are the financial requirements or expectations of the sellers? What are they hoping to get out of the transaction, and how much does that facilitate or make more difficult an internal buyout in pushing you towards an external buyout? Similarly, need for cash. Are we in steady state and we're sort of on cruise control, things are working well, and we just need to maintain that? Or do we need capital infusion for, could be a variety of reasons, to fuel some format of growth within the business, to retire some debt, to make a capital investment? Do we need to be able to bring in cash to accomplish something, and that may push you in the external direction? As owners, are we willing to participate in the earnout, so stay involved, or do we just sort of want to cut ties? I want to sell and be out. And in both cases, that can be conducive to either an internal transition, again, depending on who the buyers are, and an external transition, again, depending on who the buyers are. I think we always hear that the buyers are looking for a very strong management team, and it kind of depends on the roles of the owners as part of that management team, whether a step away or earn out is going to be part of that process. Growth strategies is another consideration. Depending on where your organization is in its life cycle, in order to continue to achieve your goals, are there growth strategies that depend on external participation? Are we looking for a strategic partner? Are we looking to align with a competitor? Are there some reasons that would pull us looking externally versus internally in terms of our growth strategies? And then culture sustainability. So as owners, typically culture is important to the organization, and think of it maybe just in terms of preserving jobs for your people, for your employee base. How important is that? And certainly internal tends to be more conducive to sustaining culture and jobs. External can certainly do that, but that becomes an important criteria for who you might work with in terms of an external buyout. So these are a number of the considerations that you think about to say, what path would be a better fit for your organization? And from this, you certainly can see it depends on what your priorities are, both relative to yourself, your future exiting the business, whether you want to stay involved for a period of time, and what sort of legacy you're trying to leave, cultural stability, sustainability of the business itself, etc. So all different considerations. And I think with that, Amy, we have our second polling question.
All right, thank you, Mark. So our second question is, are you considering making a business transition? A, yes, in the next 12 months. B, yes, in the next 24 months. B, no, or D, I don't know. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
So based on these questions, of course, if it's beyond 24 months, maybe select the I don't know. And it'll be interesting to see what kind of activity this audience is anticipating.
All right, so here are the results, Mark.
Okay, so you can see almost half are a no, and slightly over half we'll say is likely, whether it's within the next 12 months, the next 24 months, or at some point beyond that. And for those, I would just say for those who are beyond the 24 months, in terms of that's not a bad thing depending on where your business is. So for example, if you have some work to do to maximize the value of your business, then that obviously gives you the time to do it. I think we probably most commonly get requests when we're within that 12-month period, which can be good or bad. It can be good if you're capitalizing, in market conditions. It can be maybe not so good if you have some work to do to, optimize your business, and it doesn't give you, it gives you a relatively short window to work on that. And I think with that, over to you, Dustin.
Thanks, Mark. So if you're considering an internal transition, one of the first steps would be to understand your enterprise value and the factors that can impact it. A value driver is something that can increase your business's enterprise value if managed correctly and intentionally. The drivers listed here are a few of many and should be considered prior to any business transition. While some of these drivers seem very obvious, they sometimes don't get addressed because the business lacks capital, there are more pressing day-to-day problems to address, or the company's financial performance is strong enough to hide any associated or any related problems. I'd like to talk about one of the less obvious drivers on this list, which is asset and capital efficiency. When we think of asset efficiency, we think of how efficient assets are being utilized or the return being generated on those assets. For example, the sales to total assets ratio measures the ratio of a company's sales relative to its total assets. A company that can generate more sales than a competitor on a similarly sized asset base will be seen as more efficient and more valuable. Capital efficiency, on the other hand, speaks to your mix of debt and equity in the business. There is an optimal mix that will yield an optimal value for every company. The cost of equity is generally much higher than the cost of debt, and finding the right mix is important and is something that we can help you with. I'd also like to touch on management and workforce. When we value companies, we like to discuss the management team in depth. We try to identify employees that are soon to retire and whether or not they have a good replacement. We also try to identify employees that could be considered key employees that have too many crucial roles or hold too many critical customer or supplier relationships. Having a deep bench and spreading out critical roles and relationships will help diversify risk and increase the value of the company. Now I will turn it back over to Mark, who will discuss what we term internal transitions.
Thanks, Dustin. So I want to touch on, again, we're just talking internal transition, and often we get confused when we think about, okay, we're transitioning ownership of a business, and it's all about sort of the owners. But if the owners happen to be part of the management team, which the majority of our clients are, even when you have PE ownership involved, you typically have owners who are playing key management roles in the organization. So really kind of have to come at this from two different perspectives. One is ownership transition and what that entails, and the second is management succession. They're equally important to a successful transaction and transition of the business. So just take a few minutes to talk about these. So first, the ownership transition portion. So some things to keep in mind. So you're part of ownership group A, the current owners, and you want to transition to ownership group B. Does ownership group B really understand what it means to be an owner? What are those responsibilities? What are those implications? We've really many a time come across situations where that group B hasn't had experience being owners, really don't understand and haven't been involved with the sort of the ownership of the business. And I don't mean just technically being owners, but just in the running of the business. They've been in more management or technical roles, not in leadership, sort of more ownership related roles. And so do they understand what they're getting into? Do they understand what the expectations of them are going to be? Or is there an opportunity to educate as part of this process? In terms of financing the deal, what is it going to take to finance the deal? You know, internal transitions typically have one or two primary components. They can have debt taken on by the buyers as part of that financing the deal, and you can have the profitability of the business financing part or all of the deal. And so do we have in the individuals, depending on what path you're taking in terms of financing the deal, those group B individuals have the wherewithal to participate in it? And that can be relative to both raising money or debt to buy in. And the second could be if you're using profits of the business to finance the deal, that typically translates into using bonus as a mechanism and typically foregoing most or all of your bonus in terms of funding the deal. And so do the individuals have the wherewithal to take on that, I'll say, financial burden? And then you think from the business perspective, so let's say we are financing through the profits of the business in part or in total, both of which are common. What is the impact on the business of doing that? You know, if we're in a growth mode, can we afford to do that? Is that the right timing for it? Do we have just the mere profitability to fuel that type of financing internally? And then thinking about often forgotten the tax considerations. So let's say we're bonusing up to fuel financing of the business. Well, now we're increasing the compensation to those individuals that are part of Group B, the buyers, and what about the tax implications of that, especially if it's a significant increase in bonus to help fuel that in terms of sharing profits of the business, so factoring in the tax considerations. And then just thinking about change of control, and obviously that's something that's part of the equation, but internal transitions are typically over a multi-year period, and where is our comfort level collectively, Group A sellers, Group B buyers, of when that change in control will actually happen, meaning, okay, at what point does the decision-making authority shift from Group A to Group B, and does that align with where we would want it to be in terms of the ability to take on that responsibility? So then if we shift over to management succession, thinking about this would not be uncommon, or this would be common, I'm not going to use a double negative, where you have ownership playing key leadership or management roles in the organization, and you have, and that's Group A, and then you have Group B who play fulfill project management roles, technical roles in the organization, and have they been developing, or have we been helping them to develop those leadership capabilities so that they can take on some of those new roles that they may not have been performing as managers in the business versus owners in the business. And so do we need to incorporate a leadership development element to this whole process to help scale those individuals up? And that certainly could be, if you think about a multi-year process where responsibilities are being shifted from A to B, and ownership is being shifted to A and B, and being able to incorporate leadership development within those time frames. And then thinking about overall bench strength and the need maybe to develop that. So if we're taking key people out of more project management, engineering, technical roles, or I shouldn't say taking out of, but adding on leadership roles, and we have to be able to backfill some of that, what is our bench strength to be able to do that? And does that need to be an area of focus? And then, of course, the two facets of communication. So at what point and how do we communicate internally to the employee base that an ownership transition is happening internally? And how do we communicate externally to our client base, to strategic partners, bank relationships, which of course would fall on both sides, ownership and management succession, that we're going through this process in executing this transition. And so those, again, two hats, ownership transition and management succession, and both are super important to a successful transition. And then Amy, back to you for our third polling question.
All right, thank you. So the third polling question is, what type of business transition are you considering? A, internal, B, external, C, I don't know, or D, not applicable. And I do want to take this time to let you know that for those that have submitted questions for the presenters, we will be saving those for the end of the webcast, and feel free to keep submitting questions throughout using the Q&A window.
Thanks, Amy. And I was just going to say, and of course, if you were a no on the prior question, polling question 2, you'd be a not applicable here. like we've got about 25 more to respond.
All right, here are the results.
Okay, so if you were a no on the prior one, you're certainly going to be a not applicable here. So we see, I'll say, a pretty even split between internal and external, and the I don't knows, we'll just assume they're split kind of evenly. So a good mix of both. That will be our takeaway. And so I just wanted to focus in on sort of two of the elements that I mentioned on the slide prior to the last polling question, just to get you thinking about, again, we're talking about an internal transition. And think of it not just as the sellers, Group A, and whomever, that encompasses within the business. That could be, an individual, it can be multiple people, and the same goes for Group B. But thinking about, if we're truly thinking about the success of this process, really we should be thinking about Group C. And so, again, thinking of a typical internal transition, they're usually 5 to 10 years in duration. They can be shorter, they can be longer, but that's typical for what it will take to be able to generate the funds sufficient to fuel the transition financially. So you've got Group A selling, you've got a overlap of Group B with Group A while that ownership is transitioning, and eventually it's just Group B who's in the ownership role. But Group B is going to need to be able to do the same thing to make this work over the long term. And even though Group A is going to be out of the picture at that point, I'm sure, of course, they want the business to continue to be sustainable and successful. And if you had a longer transition, you might actually even have some overlap between the ownership of Group A, B, and C. And so and this sort of goes to Ben's strength, but it's Ben's strength from an ownership perspective of, if we're going through this process and we're hopefully have already identified, who Group B is, but sometimes when you start penciling this out, you find out maybe we need more potential owners to make this work, potential buyers to Group B owners to make this work between A and B, but also be thinking about, so who is that Group C? Who is the next wave of ownership? Where do they exist in the organization? And how can we start cultivating them from an ownership perspective, as well as cultivating them from a management perspective? So kind of the takeaway here is, don't be too siloed and just thinking about A and B. Think a little bit longer term and think about who's that Group C and how do we start preparing them to be part of this future, the next wave of this process. And then the other one I wanted to just focus in on a little bit was the ownership transition. And this is often not initially thought about in terms of like when this is actually going to happen and the implications of it. And so it's important as part of the process to really identify this, quantify it, and the purpose of it is really thinking about the timing of when it happens. And the importance of the timing of when it happens depends on these other considerations, sort of thinking about the capabilities of Group B. And this is an example from an actual transition that happened to be over an 8-year period. But is that Group B ready to be the majority decision makers at the time that it would happen financially? And so that's something from Group A to be thinking about is, do they have the wherewithal to make sure this is successful at the point in time that they're have that ability and the authority to make the decisions? And when are we comfortable giving that up? And sometimes, it needs to be adjusted to accommodate some of these other considerations to make sure that we're set up for success. The other thing that happens is, and is sort of embedded behind this, the analysis is, all of this is predicated in an internal transition on how the business is actually doing. Revenues, profits, cost containment, et cetera, and the ability for the business in some way, shape, or form to be fueling this transaction in transition. And so the pace could change. This is the planned pace, but the actual pace may change. And that's not so much mapping out when the ownership transition is going to happen, which is what this is intended to do. But the ownership transition may end up not happening exactly on this schedule, again, depending on how the business is doing. And that could be happening sooner or happening later, but also thinking of it in that terms and making sure that both groups are comfortable that the organization is set up for success once that ownership transition actually takes place. Okay, and then back to you, Aaron.
Thanks, Mark. So let's talk about the next stage of this. So if it's not an internal transition, then your other option is an external. And there's many factors that go into this. So let's step through it. So deal drivers. Actually, let me take a step back. How do I sell my business? What are the key considerations on an exit? So deal drivers, the question you're going to have here is the owner's goal to maximize the return on sale? Or is the legacy of the organization, the people that created the value, the most important aspect of this? This is an important determinant of who your ideal buyer will be. There's a lot of consideration here. This is your legacy, and so therefore you really want to think about how this is going to translate into the buy process. And in terms of those potential buyers, who do you want to sell to? There's strategic buyers and there's financial buyers. Strategic buyers are generally looking at your business, identifying where you can fill a capability gap. So that's good. That means you've got value that they want, and that will also ultimately drive some value for how you negotiate this deal. So on the one hand, don't underestimate the value of your business and what it means to a strategic buyer, but also be realistic about what your value proposition is. Because what you value may not be the same as what the potential buyer is looking at. Some of those things might be customers, markets, your products, your services. If you're better than anybody else in the industry doing this thing, it's going to have a high value. Certainly in the markets and customer aspect, a lot of acquisitions just take place because they want to get access to your customers or the markets that you're already in, and it's easier for them to buy rather than build. And if you have production capability that they don't have, these are things that all factor into the value of what you offer them. From a financial buyer's perspective, they typically have a shorter term view. They have a clear investment thesis. These are private equity firms mostly. They already know their exit strategy when they're looking at even acquiring you. So they know where this business is going to go in the future, whether it's going to be integrated with the platform business or standalone and achieve some other great value. They've already got that determined. So that's already going to be in their model. In terms of deal terms, the approach you take here will have a big impact on your tax strategy. And the closing conditions may require a certain structure. These things are all negotiable, and they'll be talked about in the process as we go through this. Participation in the business. This is super important. If you are the business, you are the go-to-market expert, you have all the IP, you have all the technology capabilities, that business can't run without you. That's a risky place to be. Mark had talked about building the bench strength of the team. This is really what this comes down to. If you've got a well-trained organization, they know how to run the business, you've developed a lot of capabilities, that's going to allow you to have more options. But otherwise, if it's really all about you, then you're going to have to stay on and be engaged. You can't afford to check out. You're going to have an earnout. You probably have other mechanisms in there to make sure that you're fulfilling your responsibilities, driving revenue, handing over relationships, et cetera. Financial buyers will likely bring in their own leadership team. So there's really a shorter transition period here, and it's focused on how do we get the customers, buyers, all the other folks involved with the business transitioned over to the new leadership. From an acquisition experience, this is, we see this quite a bit. One, have good, clean books and records. It's got to be organized. It's got to tell a good story. A lot of our work involves building up financial statements. Privately held businesses aren't held to the same standard. that other companies are looking for when they're going through the acquisition process. And this can really stumble and really take you off track if you don't have good organization around this. You know, there's questions like, how do you deal with underperformance? Maybe your sales targets are being met. You know, you've got a little bit too much cost. Maybe you've grown through acquisition, and some have worked well and some have not. These things are all going to be really important to understand, and you know, be clear about what your explanation is around that. The due diligence and integration process. This is pretty complex. It moves fast. There's a lot of questions, and so you know, you've got to be prepared for that. And don't forget, you've got to run the business and maintain performance throughout this whole thing. I see this quite often with executives getting really excited about the sale process, and they take their eye off the ball, and they miss a month, they miss a quarter, they miss some other major event. All of those things factor in and can really make a buyer very queasy about whether or not they want to move forward with this. What we typically see is, you know, what is the backlog? You know, what are the contracts that you have out there? Are you 3 months into a 12-month contract? Is that typical of what, you know, what a contract might look like? If you're trying to sell the business and you're 10 months in on a 12-month, really accretive, high profitable contract, that's going to have a different meaning. The question is going to be, how do you fill that gap once that's completed? You know, what's your win rate? Where does work come from? You know, the backlog becomes extremely important at this process. Explaining the story. This is how we generate revenue. This is how do we go to market. This is how it's dispersed amongst our team. And more importantly, how much of the services is delivered by employees versus subcontractors. You know, this can have a real impact on overall margins. And so therefore, you want to make sure that, you know, the margin is sustainable. And it has to be consistent more than anything else. You know, we see a lot of uptick in capital investments in the immediate 6 months prior to sale. That can also create some concerns for your buyers. Has the business been underinvested? Are these recurring expenses? You know, what else might be missing? So you want to just be clear, be consistent, and this is how we continue to invest in the business, you know, where we see opportunities to do that. And then finally, on the synergy side and resource mapping, you know, depending on who the buyer might be, this could factor into the value proposition, but it also might conflict with your belief around sustainability of the organization, people that create value. So a lot of you know, difficult decisions here. Let me just go through quickly here the external exit process. I will say that you know, this is representative of a full life cycle. Once you get into the process itself, you know, it generally goes about 6 to 9 months from you know, time you take it to market to close. And the faster you go, the better off you'll be. You know, there are, as you can tell here, 4 major groupings of activities. You've got your investment bankers, who are extremely important with getting the marketing done, soliciting offers. You've got your family planning. How's that going to work out for you? The transaction process itself with quality of earnings. You have financial, you got tax, you got operational diligence work to do, and your tax preparation. All of these things are very important and you know, need to be thought about completely. Here's the typical activities that are taking place. We're not going to go through all of these. There's some highlighted here. You know, if you have the ability to engage a broker, that can be very helpful. You know, their responsibility is really to drive that timeline, to create a sense of urgency, to track the serious buyers. Make sure the broker is representing the seller and seller only. You know, there becomes a little bit of a conflict if we're going to try to represent both sides. You know, if the broker is working for you, it's all about you. If the broker is working for both sides, it's all about them. So just be careful in thinking about how you can engage, you know, a broker to do this. They're going to do all the research. They're going to do all the finding of potential buyers. They'll market the business. They'll understand and help you through different contract nuances, whether it's a stock sale, an asset sale, and so forth. So the key thing here is, you know, before this thing gets started, they're going to go out and, you know, start answering some questions from potential buyers. They want to make sure that everyone has the same information so that everyone can give their best letter of intent. It sets the tone that this is a competitive deal and this is a valuable commodity. And the reason why that's important is what drives price is deal tension. So get as many interested parties as you can, get them all interested at the same time, and create a competitive market for your company. This will drive up the value. And this is why it's extremely, you know, complex in terms of just getting the right structure put in place. So a handful of questions you need to be thinking about for potential buyers. What's the strategy to grow the business after you sell it? Are you going to keep my employees? What do you see my role being in the business? Is there opportunity to potentially even have equity in the future business? And then ongoing, legacy part of the business, how will you ensure it continues post-close? So a lot of deep thought here. Let me just move this along here for us. And finally, once the process starts, it's stressful in multiple different ways. The decision equal parts strategic, financial, largely emotional. This is something you invested your entire work life in, and you want to make sure this is the right way to go. Don't be shy about hiring the A-team. Right now is not the time to be a little cost conscious. You want to make sure that you're investing correctly, that you have the right coverage. There's a lot of activity that goes on here, a lot of things that could go wrong. Plan, start early, test your alternatives. There's a lot of different ways of looking at how to sell this business, how to market that. And you still have time to implement some changes, before you actually start getting into the last 6 to 9 months. So even engage some support to say, I don't have good books and records. I don't have all my contracts sealed up. How do I get those things in place before I even take it to market? That investment that'll be well worth its effort in doing that. And then commit to the decision and make the decision right. Price may not be the only thing that closes the deal. It could be the perfect fit is really what you're looking for. And once that strategy is set, the process is going to move very quickly. So don't be surprised that you've got multiple buyers that want to get in and take a look at your business and due diligence. And they're going to ask a lot of the same and similar questions over and over again. You have to be prepared for that. But ultimately, you're trying to drive the the value in the business. You want to represent it correctly, that there is a lot of value to be had here, and therefore, continue on those conversations. So I know I went through that very quickly, but for sake of time, I think we have one more polling question. Is that correct, Amy?
Yes. So our last polling question is, how would you assess your readiness for a transition? A, ready and working with advisors to start the process. B, starting to think about it and looking for help. C, not ready, or D, not applicable. And for those that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts, and we will also be sending them out via email tomorrow along with a recording of this webcast. We'll leave this up a little bit longer so everyone can get their CPE. Okay, here are the results.
So I'll assume that the not applicable was for those who are not anticipating buying, and then some version of ready, in process, not ready. So for those who aren't ready or starting to think about, hopefully you weren't in the 12 months category of a transition. And Amy, do we have some questions that were submitted?
We do. So we have about a few more minutes to go so we can get to some of these questions. So I'll just throw them out, and then any of you that want to answer, feel free. The first one is, what if I lost a significant contract? When do I need to disclose that information?
Amy, this is Aaron. Let me tackle that. I think the important thing to understand here is that during that diligence process, everything will be uncovered. So you just have to be clear, you have to be consistent. Now, you don't want to get out too early. I mentioned that early stage where you're fielding questions from potential buyers, you're trying to gain the interest. Once they have the letter of intent in place, that's when you're going to have to be a little more candid with them in terms of, here's what our historical trend has been. We've had peaks and valleys in the past. This is how it works. We had one that lost recently. Think about what that story is going to look like. If you don't disclose that in that process, in that time frame when they're underneath exclusivity, and they discover it later, it's going to reflect poorly on yourself. Amy, anything else?
Yes, so this is a long one. What are the 3 major financial ratios that a buyer looks at when determining the financial performance of a business? Are most valuations based off of historical and future EBITDA, or is the purchase price typically a multiple of future estimated EBITDA? And let me know if you need me to repeat any of that.
This is Dustin. I'll provide my 2 cents on that, and if Mark and Aaron want to add some context, that'd be great. But as far as the 3 major financial ratios that a buyer looks at when determining the financial performance of a business, sticking to construction, I would have to say growth in terms of revenue growth, some sort of profitability metric such as EBITDA, and then backlog is also very important. How big is the backlog? How long will it last? How good are you at replenishing it? And then are most valuations based off of historical and future EBITDA? It can be a mix. Buyers typically are more interested on what's going to happen in the future, but the past is also very important because it shows what the company has been able to do. So most valuations will use a hybrid approach where it considers both historical and future EBITDA in the analysis. And is the purchase price typically a multiple of future estimated EBITDA? It depends, but in a lot of cases, it can be. One other thing that is considered in construction valuations quite heavily is the asset, the value of the company's assets, because a lot of times these are very asset-intensive businesses, and in some cases, asset value can actually be greater than the value determined by a market or an income approach.
All right, thank you. It looks like we have time for maybe one more question. Would a high valuation or low valuation be ideal when contemplating an internal transition strategy that involves gifting ownership interest?
This is Dustin. I'll take that one too. A low valuation would obviously benefit the individual making the gift, as the tax liability associated with the gift would be lower. Some of our clients took advantage of the lower valuations exhibited from March through June of 2020 by, by making gifts at that time. So sometimes folks luck out and the timing is good and they can capture a low valuation because of what's going on in the market. And I'm not suggesting waiting for another downturn to plan your gifting, because one must also look into and account for the potential tax changes that we discussed in the presentation and the fact that markets generally improve over time.
All right, thank you. And it looks like we are out of time. So I do want to thank Mark, Dustin, and Aaron for a great presentation today. And for our attendees, feel free to reach out to our presenters if you have additional questions. Their contact information is on this slide and in the console bios as well. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I will keep the console open for a few minutes to give you time to download. And a copy will be emailed within 3 weeks if you have difficulty downloading it now. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And finally, here is a link to an online survey for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.
Thanks, Amy.